Morning, everyone. So we have two notes this morning. First is on FreightCar America. They reported their second quarter financial results, which were very strong. They reported adjusted net income of $3.8 million or 11 cents per share. That compares to our estimate of $2 million or 6 cents per share. Revenues came in above our estimates. Really what drove the quarter were railcar deliveries were 939 units compared to 1,159 units during the prior year period, and our estimate of 850. Gross margins were very strong relative to the prior year period and our estimate. During the quarter, FreightCar received 1,226 new railcar orders, so now they have a very strong backlog of orders valued at roughly $317 million. And we expect those deliveries to accelerate throughout the year. So they did increase their utilization across their 4 production lines, enhanced productivity, and then really benefited from a higher margin product mix. The year-over-year decline in deliveries was really attributed to a strategic shift in the product mix towards higher margin railcars. The company will host a conference call at 11 a.m. Eastern. Looking at it, we think that not only was the product mix that also, impacted the year-over-year change in the rail car deliveries, but we think timing is also a factor. So we expect a very strong second half of the year. So our rating remains an outperform based on the company's favorable cash flow growth outlook, driven by market share and new product introductions, margin expansion potential.